Welcome to everyone. I'm Francesca Magli, Assistant Professor of Business Administration in University of Milano Bicocca. In this lesson, I will talk about the basic concepts of financial statements. The financial statements are formal record used to give readers an overview of the financial results, activities, and condition of a business. What are the most important reports within the financial statement? The financial statements are three most important: the balance sheet, the income statement, and cash flow statement. The balance sheet is a statement of financial position. The income statement is a report that measures the performance of the company. And then there is the cash flow statement, reports on a company's cash flow activities. Usually, external financial statement is prepared on the accrual basis accounting, which means that assets and liabilities that are included into balance sheet are recorded when they are committed to, and revenues and expenses that are included into income statement are recorded when they occur, rather than when they are actually paid. This is the first most important statement, the balance sheet. The balance sheet presents a picture of the financial position of an entity, an enterprise, at a particular point in time. The balance sheet shows what the company owns, or the first resources, assets, such as cash, accounts receivable, and equipment, and what the company owes, liabilities, such as accounts payable and loans. Any remaining difference between these two amounts, so the assets and liabilities, show what belongs to the owners as their equity. These three amounts should always be in balance, in that assets is equal liabilities plus stockholders' equity or shareholders' equity. In the balance sheet, assets are in the left part and represent investments, liabilities and owners' equity or stockholders' equity are in the right part and represent capital. But what is an asset? An asset is a resource owned or controlled by the firm. It is expected to generate future economic benefits and arise from a past event or transaction. Assets are the economic resources owned by the company. An asset can be something physical, such as cash, machinery, inventory, land, and building, an unforeseeable claim against others, such as accounts receivable, rights such as copyright, patent, trademark, and assumptions such as goodwill. Assets shows on their owner's balance sheet are usually classified according to the ease with which they can be converted into cash. But what is a liability instead? A liability is a company financial debt or obligation that arise during the course of its business operations. Liabilities are one type of the sources of capital, a present obligation of the company to transfer economic benefits in the future to another party and arise from a past event or a transaction. Liabilities included in general loans, mortgages, and accounts payable. What is the third part of the balance sheet? The owner's equity. The difference between assets and liabilities originates owner's equity, called also net assets. This element is also referred to as shareholders' equity. Then the amount of owner's equity is equal to the amount of assets minus the amount of liabilities. The owner's equity is the wealth of the owners in the company. It is composed of two parts: the owner's investment in the business and the earnings generated by the operation and retained in the company. Usually, owner's equity are the word used on the balance sheet when the company is a sole proprietorship. Often, if the company is a corporation, the words stockholders' equity or shareholders' equity are used instead of owner's equity. Most common owners' equity accounts are share capital or common stock, share premium or additional paid in capital, preferred shares or preferred stock, retaining earnings. In this representation, we can see the balance sheet formats. We can see the different categorization in Anglo-Saxon countries compared to the continental European countries. The structure of the balance sheet is the same, but the current items are up in the Anglo-Saxon countries, whereas they are below in the case of the continental European countries. Assets are classified into two categories, current assets and non-current assets. Current assets are the resources of the company that are either cash or that the company expects to convert into cash to sell or to consume during the next 12 months, or during the firm's operating cycle, whichever is longer. Non-current assets are assets that are non-current. They are resources that the enterprises intend to use for a long period of time to conduct its operations. Most common current assets are cash, short-term investments, inventories. Most common non-current assets are property, plant and equipment, intangible assets, financial investments, goodwill. Businesses sort, furthermore, their liabilities into two categories, current and long-term. Current liabilities are debts or present obligation, payable within 1 year, while long-term or not current liabilities are debts payable over a longer period. Most common current liabilities are account payable, short-term loans, the taxes payable. Most common non-current liabilities are long-term loans, mortgages, pension obligation, restructuring provision, litigation provisions, capital lease obligations. What is the income statement? The second most important document reports inside of the financial statements. The income statement, defined also profit and loss statement, statement of income, statement of earnings, or statement of operations, is a financial statement that measures the performance of the company. It shows how the company performed during the course of its operation for a fixed period of time. It accumulates information over a set period, typically a year. Income statement include two most important macro items that are revenues and expenses. Combined, these numbers originate the net income, so profit in the case in which revenues are more than expenses, or loss in the vice versa case. Net income, called also net profit or net earnings, is a summary figure of the performance of the company. But what is the difference between revenues and expenses? Revenues are increases in owners' equities as a result of operations conducted by the company with the intention of generating profits. Most common revenues are sales. Expenses are decrease in owners' equity as a result of operation conducted by the company. Most common expenses are cost of materials, personnel costs, depreciation, amortization, tax expenses, financial expenses. In this slide, we can see the structure of the income statement. In particular, this is the representation of the income statement with the detail of the most important partial results. The gross margin, for example, is the first, depicts the difference between revenue and cost of goods sold. The earning before interest, tax, depreciation, and amortization represent a measure of a company's ability to produce income of its operations in a given year. Operating profit, also referred to as earnings before interest and tax, represents the earning power of the company with regard to revenues generated from ongoing operations. Then there is profit before taxes, called also pre-tax profit or earnings before tax, regards a profitability measure that looks at a company profits before the company has to pay corporate income tax by deducting all expenses from revenue, including interest expenses and operating expenses. Net profit is the final and fundamental profitability results, and it represents all the revenues less all the costs of the business. The third very important document of the financial statements is the cash flow statement. The company raised capital from its owners that are inside of the owner's equity in the balance sheet and from lenders inside of liabilities. With this capital, the company invests in productive resources that are in assets inside of the left part of the balance sheet. The portion of the capital not yet invested in productive resources is shown as cash, another asset in the balance sheet very important. In order to analyze better cash flow statement is used. The purpose of the cash flow statement is to show where an entity's cash is being generated, cash inflow, and where its cash is being spent, so the cash outflows. Over a specific period of time, it is important for analyzing the liquidity and long-term solvency of a company. The cash flow statement uses cash basic accounting instead of accrual basis accounting, which is used for the balance sheet and income statement. In the income statement, for example, the use of accrual basis accounting is important because a company may accrue accounting revenues but may not actually receive the cash. This could produce profits and taxes payable, but not provide the cash. There are two different methods to calculate cash flow statement, the direct method and the indirect method. The main difference between the direct method and the indirect method involves the cash flows from operating activities. The first section of the statement of cash flow, there is instead no different in the cash flow reported in investing and financing activity sections. Under the direct method, the cash flows from operating activities will include the amounts for lines such as cash from customers, cash paid to supplier. In contrast, the indirect method, we show net income followed by the adjustments needed to convert the total net income to the cash amount from operating activities. The direct method must also provide a reconciliation of net income to the cash provided by operating activities. This is done automatically under the indirect method. This is a picture of the direct method. This method takes all the cash inflows and outflows from the cash account and classify them in cash flow from operations, cash flow from investing, and cash flows from financing. In this method, we include in the cash flow from operation the collections from customers, from other operative income, to payment to suppliers, payment to employees, for interest and for taxes. Cash flow from investing activities will include the outflow of cash for long-term assets, such as land, buildings, equipment, etc., and the inflows from the sale of assets, businesses, equipment, and so on. Most cash flow investing activities are cash outflows because most entities make long-term investments for operation and future growth. Cash flow from finance activities, the cash outflow to the entity's investors, for example, interest to bondholders, and shareholders, for example, dividends and stock buyback. And cash inflows from sales of bonds or issuance of stock equity. Most cash flow finance activity are cash outflows, since most entities only issue bonds and stocks occasionally. The last slide analyze the indirect method. In this method, basically, the cash flow from operations starts with the net income plus no cash items, such as depreciation, amortization. Since accounting profits are reduced by no cash items, in this statement they must be added back to accounting profits to calculate cash flow. Cash flow from operations is an important measurement because it tells about the viability of an entity's current business plan and operations. In the long run, cash flow from operations must be cash inflows in order for an entity to be solvent and provide for the normal outflows from investing and finance activities. The cash flows from investing and the cash flow from financing are presented like in the direct method. So that's all. Thank you very much for your attention.